Hello, ladies and gentlemen. This week was slightly better. We started basically negative and we ended up equally positive. So minus 18 to plus 18, a swing of 36. You know, we are here, if you have a look, the price is now above the moving averages. So we're still in TLT in risk off, but basically the picture's getting a slightly bit better. I am, though, not a huge believer in this rally because you will see later in the video what I think is going to happen in the next couple of weeks to S&Ps. But also it's slightly underwhelming that on a week when the Fed basically says, hello, we are just about to cut rates, that the market doesn't do more than it has done. Obviously, the market is beginning to rather doubt the reason why the Fed might be cutting. Could it be that they see some really bad news coming down the road? Well, who knows? All I know is that deviations have been very good for us. They have always told us when not to be invested very heavily, and they've also told us when to counter trend buy. As you can see how close they are, how close we are to the top, and you will see later that this actually matches with the monthly and weekly and daily Bollinger Bands plus the 17 times Blue Angel. So I really don't know how many more warnings you need up here to say if you need to be long, rather buy calls than stay outright long. Just like bad things happened here in this period, and we had all this type of pain, very much the same thing could happen here. You know, slowly meander about and then wham, back down to 28.64. Not a good picture for the time being. The fundamentals show that we are very close to the time 17 Blue Angel, which has capped it for such a long time. So next week, I certainly do not expect the market to cross 3,000. And we will see later from the Bollinger Bands on the monthlies and weeklies that is also very unlikely to happen. So we are within 1% of a decent medium-term high. So that really doesn't give us too much confidence in being outright very long of anything at all. It is much better at this stage, if you have to stay long, to stay long via calls rather than being outright long, because the downside is wide open. Well, what happened this week in interest rates? And as you can see, the 2-year is actually the only one that's appreciably lower. We started the week around the 188 area, and we tried to go higher for a couple of days, but as soon as the Fed came in, we came all the way down below 170, and we closed the week at 177. We have tried to retrace, but it's very weak and it's very anemic. The trend in 2 years is completely intact. We might see some more retracement early part of next week, but I really expect the 2-year to be stable to lower for quite some time, and certainly until the July meeting of the Federal Reserve, when we certainly expect at least a 25 basis point cut, data permitting. The differential between the bonds and the 10-year is definitely in a new range. We are staying well above this minus 245 basis points, which was the ceiling for many a month, basically throughout the whole of 2018 the middle of 2018 and a whole year. We've now broken above, and the DXY has responded. I still expect this to go up towards the area of around 200 and basically trade at the same level as we were trading in 2017. Slowly, it'll take many weeks and months for it to reach the 200 area, but I do expect rates in the States to continue falling faster than rates in Europe, simply because the Treasury market is the only market which offers you any kind of real yield. I think all the pressure for cuts is going to be borne by the Fed, while the ECB might do 10 or 20 basis points here or there. The Fed has much more room, and I still expect the 2-year to go down towards the 130 area, and that should slowly enable this spread to move towards 200 basis points differential. The 5-year note and the 10-year note, as you will see, are actually more difficult to predict than the 2-year note, simply because the yield curve is steepening whenever there is pressure on the market. So the 5-year note, which is now trading at 180, could easily go back up to this line, which is 187, and after that here to 193. While the 2-year note, I really do not expect to go up by as much as the 5s. So it's quite obvious that every time there's any kind of pressure to back up rates, it's actually the longer end which is taking the brunt of the selling, and the short end, the 2-year, remains bid after a while. So it is much better to stay focused on the 2-year unless the other contracts back up enough. I would have thought if we see 193 next week, it's going to be a wonderful level to reinstate, to put on a position long of 5-year notes. And if we change now to the 10-year, you will see that the picture is actually completely different. It closed at 206-ish. It could easily go all the way back up to what is this, 229. This is a much more volatile contract than the 2-year note will be, certainly on the upside in yields. Certainly at 229 it's a big gift, but it would not really surprise me to see 222 or something like that. You can see the reactions from this 2 level that have happened in the past. If I now change the picture to a weekly, you will see that the reactions from this level have always in the past been quite violent, and they have reached even the 230s. That is not to say that we are not going to have a wonderful opportunity to trade it all the way down to 169, because that is what I expect. I expect the 10-year note to trade 169 at some stage, but quite possibly via the 230s, if you can believe that. So keep an open mind. All the pressure when rates are going higher was going to be on the long end, on the 10-year, the 5-year, and especially the 30-year, which actually makes sense because the funding needs of the government are still there. The selling by the Chinese and other central banks is still there. So all the vulnerability is going to be in the 10 and 30-year tenors. But if we see 233 anytime over the course of the next couple of weeks, that is going to be an absolute gift, because after that we will most certainly see 169. I'm convinced of it. One of the reasons why we might see a backup in the 30-year and the 10-year actually comes from gold. Gold is so hugely overbought here. As you know, gold basically trades as an inverse to real yields and to the dollar. So when real yields are low and going lower, gold goes up, and if the dollar does the same, then even better. Gold has now gone up for 1, 2, 3, 4, 5 weeks on the trot, and it's reached this amazing 14-17 level, which has seen it back off so many times in the past. If it doesn't, it's not 14-17, then it tends to be 14-57, that kind of range, that kind of couple of percentage points. It would not be surprising to see a backup in gold at some stage. And if I enlarge this, sorry, let me try again. If I enlarge this, you'll see that the weekly Bollinger Bands, above which it doesn't really stay for very long, come in at 1370. So really would be no shock at all to see gold next week test this 1370 area, which is probably going to be a wonderful level to buy. And in fact, I'm going to put in a reminder here around, well, I'll actually put it a little bit higher than this. I would have thought at this kind of level, 1369, 1370. If we can get there, I will certainly want to buy the market. That could coincide with a backup in yields, and that is what worries me about the 10-year and the 30-year. Otherwise, gold is beginning to look great. I would like to see it do a cup and handle here, so this being a huge cup, the handle, 2-3 weeks of consolidation, and then zoom up. That would be my idea, but on any backup, really towards the 1380, 1370 area, it still pays to buy some calls. And conversely, our big trade in DXY is now triggered. The market closed below 96.47, the swing level for the year, and I think now we are beginning to see the very early stages of a significant trend lower in the dollar. What could not the dollar? Well, the yield differentials as we saw them earlier. If the 10-year and certainly the 2-year yield differentials keep on coming in between the euro and the dollar, that is likely to put pressure on DXY. We know that that is the favored side for Donald Trump and the Treasury, and therefore it makes sense. We have broken this trend line. We've closed below the 200-day moving average for the first time since the early part of 2018, and now I expect slowly the trend to start developing. Where do I see it going? Well, certainly to 92.50, but quite possible that we see these lows again around the 90 to 89 area. What is actually holding me back from saying it's going to happen immediately, and why do I think there might be a nasty shakeout in the bond market which forces the dollar slightly higher? We are very oversold on the DXY on the very short term time frame, but also we are right at the bottom of the Bollinger Bands, and while we could go a little bit lower, it certainly doesn't feel like we will be going lower by more than 0.25% or something like that. If we now change this to a weekly setting, you will actually see what I mean. The weekly Bollinger Bands, well, we closed very much right on top of them, and they're still converging. When it does that, it's quite possible that the market holds in for 2 or 3 weeks, basically does a bear flag, and stops everybody out who's got into the trade below 96.50, and then starts going as soon as the Bollinger Bands go out. That is what worries me, but there again you have this example here, and we will see in the next couple of weeks what the market does. You will see what it did here when it got to the narrowed Bollinger Bands. It just stayed, basically traded in 0.5 point, 1.1% range for 3-4 weeks, and then it really started to pick up speed. If we get this kind of pattern in reverse, and because the bond market has not had a quick spike higher, then that is what's likely to happen. And that is why I think the best position is to have straddles. If the market does come back, we have ammunition to put on some outrights as well. That is what worries me about the dollar, and that's why I'm not completely all in. I just have straddles you see here we have the 200-week moving average pretty flat. We have these amazingly tight Bollinger Bands. I think it's unlikely that we do anything but bear flag and stop everyone out over the course of the next 2 or 3 weeks, which does make sense because I don't think the market's going to go very far in yield terms before the Fed meeting in July. This is a chart of Euro USD, which is the largest component in the DXY. And as you can see, we closed above the 200-day moving average, which is still downwardly sloping, but we're still very much below the 114.84 swing level, which was so important a couple of years ago, and really basically, it determined the direction of the market: bullish above, bearish below. I think slowly we at some stage over the next 2 or 3 days we might go there and then back off down to the 200-day moving average and retest it from above, and slowly, with time, turn the moving average, because it's still coming down. This is why I don't think DXY is ready to explode as yet, but it's going to take time. It's just time and range. So if the market now ranges between 113 and 115 for a bit, does something like this, that would be wonderful, because that to me confirms that sooner or later DXY starts going lower and Euro USD breaks through this very important pivot point at 114.84. This is a weekly chart of Euro USD. And if we enlarge it, you will see same story as in the DXY, the contraction of the Bollinger Bands. Look how well it just one touch, 2 touch, 3 touches off it goes of this 111 area that was so important a couple of years ago. Who says that the market has no memory for price? So again, since Euro USD confirms the view of DXY on the weeklies, let's see if we can just sit on the Bollinger Band, or do we actually retrace? Because if we just sit on the Bollinger Band, then the move up is going to be quicker. If we retrace some, then it gives us the lovely time, the month or so that we need in this area before we start breaking higher. But certainly my expectations would be that we will go and test at least these levels around 125. What about equities? Well, they've had a good week, basically helped along by the Fed and the prospects of easing. Why do I think that we might be in for a bit of a nightmare? Just a very quick move lower, because the bonds and the equities are now tied together. The reason why equities are going higher is because the bond market went higher or lower in yield, and therefore the long-term discounting factor got better. We are very, very close, as we saw earlier, to the Times 17 Blue Angel. We have falling expectations of earnings going forward. So I think it's going to be very tough for the equity market to do much better. And a market which doesn't go up tends to test the lower moving averages. If I enlarge this, you will see where they are. They are rising, but certainly at some stage I would expect a test of this 29.30 area, and then quite possibly around the 29.10-15. I do not expect it to go all the way down to 28.64, but stranger things have happened. When the market gets a little bit of a push on, it can happen. We will see from volatility that that is not very likely to happen. But certainly a move down into the 29.20s, 10.20s, something like that, at the early part of next week could quite easily happen before another push up. This is a weekly chart. The close wasn't too bad, 29.50. you will see that how close we are now to these Bollinger Bands. This is 2980. It'll probably be 2985 or so next week. So as you can see, we could be repeating this pattern here of basically crawling along the top of the Bollinger Bands. But you can also see how open we are on the weeklies. We're not so open on the dailies, but on the weeklies, we could easily come back down to 2864. You can see there is really no moving average support until you get all the way down into the 2845 area. So I'm very weary of the downside. I would definitely expect around 2920, 2920, 2910 at the very least next week. This kind of area here where there is some support. After that, the top, I really think 2990 is going to be very, very, very tough to break, simply because we have the weekly Bollinger Bands, we have the daily Bollinger Bands, and we have the monthly Bollinger Bands, and we have the times 17 Blue Angel as well. Very, very tough to break there. If we don't break there, I think we'll go down towards 2910, 2920 at some stage. This is the monthly chart, and as you can see, really here we have 2981 as the top of the Bollinger Band. The market tends to respect the top of the Bollinger Band very well, and if it goes a little bit through it, then it comes back. You can just see how well it has respected it every time. It always comes back to it. So I really don't expect a melt up of any sort, and really there isn't very much support here on the monthlies all the way down to 2818 or so. I certainly don't expect that to happen next week. I expect to close somewhere around here, probably 2950 for this extra month, and then after maybe another couple of weeks, a couple of months of hesitation around here, then we are ready maybe to go higher. But certainly at some stage I expect the market to come back and test 2864 on a monthly basis. This is a weekly chart of NQ. I can enlarge it. And this is what I mean by NQ just doesn't trade right. There is nothing too wrong with this chart. I think it's just going sideways. You would have thought that with the market all-time highs in the S&P, the NQ would be leading. It's not. It's lagging the S&P. All the buying is actually in defensive categories in the S&P, like XLP, which is to me quite amazing. I really don't think that until we get a decent new high on the weekly chart above 7,915 or so, and NQ starts leading again, that we can bust that 3,000 level. I just think the S&P, the other sectors just do not have enough carry power to make that much of a new high. And this to me is a sideways market which will probably stop a whole load of people out and then come back and test again this kind of 7,550 area. It's not a market that I feel comfortable with, simply because the risk in NQ is so much greater than in S&Ps. So why settle for an identical kind of return? To me, it's a market probably best left alone. And again, we come to the multitude of divergences that we have. We have a divergence here in the transports, simply because you can see how far below they are the all-time highs. They are still below this high, which equates to this high here in the industrials. The industrials are making new highs, but stalling, while we don't really see any kind of attempt to even break away from the down sloping 200-day moving average. If I enlarge this chart for you, you will just see that every attempt to close significantly above the 200-day moving average, which is so negatively sloped, fails. To me, this is a sign of a market we just cannot hack it. And really, if transports cannot even get back to this kind of level where we were when the industrials were at 26,700-ish, it's unlikely that the industrials can keep on just going. This is a market which definitely requires time, and therefore that very much supports my argument that 2980, 2990 is going to be about as far as the S&Ps can go. And if we are only a percent and a half from the absolute maximum that a market can offer, you can bet your bottom dollar that at some stage some nasty surprise is going to come out and it'll just whiz down 2 or 3% just for fun. This is a daily chart of volatility, and this is where it touched when I tweeted to you that to get out of volatility shorts. Basically, this is yet another divergence. We are at a very important level, 1540-ish. If we break above 1540, we're definitely going to 1620, something like that. The 200-day moving average is still trending higher. So we could get even to 1720, and that to me equates to a market which is now, breaking 2900 in the S&Ps and going towards the 2864 area. I think it won't do that. I think it'll stop somewhere between this 1627 and 1720 area and then come back down. So 2910, 2920, that is something that should really not surprise at some stage next week. And if you're not sick of divergences, here's another one. This is the weekly chart of vol. And you will see that actually we close back in the range of the previous week. So if you compare that to what the S&P has done, you will see how big a divergence that is. I don't expect it to do too much on the upside, but this definitely says to me that at some stage over the course of the next week or two, rather than powering through 3000, we are touching 2900. This is a chart of the DAX, and I cannot imagine that the DAX is going to be very happy if the euro starts screaming higher. It's full of exporters. The exporters are not going to like it. So I'm looking for opportunities actually to short the DAX as well. It's not a bad chart yet. I want to see what happens over the course of the next 3 or 4 weeks, what kind of a pattern we get on the weeklies and the dailies, because then we might be able to get a better idea for a trade. Certainly, I would expect as the euro dollar goes higher towards into the 120s towards the end of the year, the DAX to be somewhere around the 11,500 area. That is really not expecting too much of it. And I have some very long-term expiry September 1800, 1500 put spread, 1800, 1400 put spreads, and I still think that they will come into the money coming late into the summer. So these are my biases for next week. I'm afraid, as I showed you earlier, of a quick retrace in the longer end of the curve, simply because I know what they're like, and they like to stop everyone out. People are long the wrong part of the curve. The curve is steepening. It is bull steepening, which is actually a very good indicator that the dollar's going to go lower. But as we saw, probably not yet. So in the next 2 or 3 weeks, I'm afraid that the 5s and 10s are going to have 1 or 2 bad days, and that those bad days shouldn't put us off our longs So we know the levels that we want. 229 to me is a gift in the 10-year note. I'm really looking forward to it trading there and buying the hell out of it. I think it's unlikely to break 2 till after the July Fed meeting. 2-year note, could it go to 193? Yes, it could. But do I think that's a gift? Yes. So I am still 60% long. I will add on bad days, simply because I think the ultimate objective of 130 in the 2-year note is very attainable over the course of the summer or early part of autumn. Bund and Bobble, I just don't trade them anymore because I have no idea what yield level I'm looking for, what my target is, so I just trade them on a spread towards to treasuries. SPX, as we saw, 29.80.90 is about as high as the monthly and weekly Bollingers will allow, plus the 17-time Blue Angel. Any longs above there really are silly. So you want to basically, if you have to be long for your investment purposes, switch it to calls, pay away the 0.5%, who cares? Because really we don't have any big support until 28.64. We have minor support around 29.10, 29.20, which I think we will see at some stage. So being long of calls makes much more sense than outright longs. NQ I just don't like. It just, it's just not right. The RUT needs to break above 1571 for any kind of rotation towards 1624. It's not even coming close to doing it. So yet another divergence. I don't know how many times I've mentioned divergence, but there you go. And VIX, as I said last week, better odds of some upside action in equities next week, but it's only 60-40. And really it's a question of, does the market just, slowly wedge upwards, crawling along those Bollingers, or does it have some pretty nasty moves down? The VIX is telling me no way do we break 28.64 anytime in the next 3 weeks. So 29.10, 29.20 is likely to be about as much as we can expect. Now the DXY is triggered. I'm now long just the straddle. For all those who follow Charity Hedge Fund, you will see in the tweets, I'm just now basically essentially long a 96.50 straddle. No more delta hedging. I'm looking for these 1, 2, 3, 4 weeks of indecision. Who knows? I want to see what it trades like over the course of the next couple of weeks. Does it just sit on the bottom of the Bollinger Band and expand it, or does it have some pretty meaningful bounces? Then I will know exactly what to do. And really it'll only start moving when the Bollinger Bands allow it to move, and that could coincide with the July meeting, when I'm absolutely sure the Fed will cut. Thank you very much indeed, and tweet to you on Monday.